Good afternoon. This is Craig Modelmog of Cornerstone Wealth Management for this week's episode of Wall Street Exodus. Welcome. I hope you guys are good. I missed you last week, but real excited today. I've got a really good show. We're going to close it out for this year as we get ready to finish up 2021 and kick open a new chapter titled 2022. So welcome. Today is Friday, December 17th. We are 8 days and counting. Actually, not 8 days. I was going to say 8 days and counting. From Christmas. It is the 25th. It is. It's 8 days. 8 days away. Hopefully, you got your Christmas shopping done. If you didn't, hopefully when you go shopping, there's something on the shelves for you to buy. So anyway, hey, before I get going here, we have to throw out our proverbial disclaimer. Just to make sure we're doing this right. The preceding information and topics on this presentation are for informational purposes only. None of the information contained herein constitute an offer to sell or a solicitation of an offer to buy any security or investment vehicle, nor does it constitute an investment recommendation or legal, tax, accounting, or investment advice by myself. Investments can and will lose money. They are not FDIC insured. And without further ado, we're going to get this thing going. So welcome. I hope everyone's doing good. Regardless of where you are, if you're here or on the front range of Colorado, we've had a very mild winter. Bad for skiing. Nice for people that like to play golf. That's okay. Wherever else you are, I hope you've had a wonderful start to the winter season and are real excited for the holiday season that is ahead of us. So got 4 things we're going to hit on today. We're going to dive in. A Q4 transition from Q4 to Q1. We're going to talk about what the data is showing. The VIX, the volatility paradigm could be changing. This goes back to June when we put in our lows from a volatility standpoint. I'm going to hit on that a little bit. I'm going to focus on some 2022 points of interest, and we're going to wrap this up with Fed Pals. My interpretation of Fed Pals Fed meeting this past week, where they are going to increase the pace of their tapering. You say taper, Craig? What is that? Well, we're going to talk all about that. For those of you joining me the first time today, welcome. This show is uncut and unedited. I just grip it and rip it like John Daly. If you don't know who that is, Google him, find out. He hit the hell out of the ball. Not going to say what kind of a little white ball, but he hit the tar out of it, and you didn't know where it was going sometimes. And sometimes in my show, I don't know where it's going, as many of you will attest to. So anyway, let's start with number 1 here. The transition in Q4. If you remember, we went from Q3, where we were in an inflationary period of time, okay, where we had growth that began to slow in Q3 and inflation was rising at a pretty good rate. Q4 brought a reversal where we saw growth begin to reaccelerate along with inflation. Here's what's happening though, and here's what you're not hearing in the news anywhere, basically. We're starting to see some deflationary signs. And again, on my show, I like to point out the things that aren't being talked in the mainstream, not being talked about by many people, to be candid with you, because it's in those little details is really where lots of great information lies. So what I'm saying right now, and this is data driven, this is not an opinion, okay? There are very few opinions. I was going to say no opinions. That would be inaccurate because I do have my own opinions, but I have very few opinions. The data is beginning to show an inflation that's declining, which is going to lead us into Q1, where we're going to have growth continuing to accelerate, and we're going to have inflation decelerating. Now, the kicker on both those is, what is the rate of change? What is the rate of change? The rate of change is how quickly, it's like when you're pushing down on the accelerator, how quickly are you accelerating in your car, or how quickly are you decelerating? Are you braking? Okay, that was what rate of change measures. That's what I dial into to help me position portfolios and kind of get an idea of what is coming. So what things are being shown right now is that we are going to enter a deflationary period in Q1. Going into Q2, we're looking for both the economic activity to continue to decline, as well as inflation going into Q2 in the middle of the year. It's going to be very subtle. That sounds a lot worse than it is, so don't get all worried like the sky is going to be falling, because I really don't anticipate that. It's still actually a pretty decent environment for stocks if you're in the right stocks. Number two, volatility. This is a big deal. Volatility is crucial. It really drives everything. When volatility rises and peaks, we usually see markets sell off. That's the result of that. When you see volatility decline, usually mean equity markets are very healthy. It's a very good signal on the attitude of the market. Is probably a really good way to phrase that. Well, just recently, over the last couple of months, we've seen a potential paradigm shift in volatility, for one of being trending downward to one of trending upward, which I think that goes into my next points here of interest when I'm really staring at 2022. What I'm really thinking, and see, I had my stuff all lined up. See, this is, once again, I prove that, this is kind of a grip it and rip it show. So anyway, June, we saw volatility bottom out, meaning that was when the series of lower lows in the VIX began to bottom. It actually put in its bottom. Along with that series of lower lows, we saw lower highs. Now, what have we seen since then? We have seen higher lows along with higher highs. So when you look at it from a trending standpoint, there's a channel that you track from the highs every time you get a peak in volatility, as well as the lows every time you got a basing effect in volatility before you saw another spike. And in that trending segment of the VIX, we have seen that reverse. So now the market, or the VIX in general, is putting in new series of higher lows and higher highs. Should that continue? I actually think it will. Again, doesn't mean that stocks are going to be bad. A lot of times, volatility is associated as a direct correlation to stocks are bad. No, that's not the case. We've continued to set new highs in the markets here recently, although much at a slower pace than the beginning of the year. But we've still had volatility on the rise. In fact, volatilities remain elevated above a VIX of 20 here for now a couple weeks, which tends to be what I call the chop market. If you slice volatility up into three different segments, you have from 20 down to zero, which we've never seen a VIX of zero, but anything below 20 is very healthy for equities. Equities love low volatility. From 20 to 30, I'll call that the chop bucket. That's where investors get chopped up, because volatility spikes, they sell. Volatility begins to drop, they buy, and it's at the wrong times because they're not focusing and they don't know what they're doing and why. So it tends to chop people up. Above 30 is the poop bucket, where bad things happen and it's a real uninvestable area of the equity market. We haven't seen that very many times. But anyway, watch volatility. That's something I'm going to be talking in and cluing in a lot, okay? 2022 points of interest. Here's what's going to be interesting. We've got governments and central banks around the world that are going to be faced with rising interest rates, as well as their continual manipulation of the interest rate world. We have economic growth is going to begin to trend lower. Okay, again, don't get freaked out here, because this is a lot of sounding bad, but it's all relative. Okay. So we're going to see that economic growth is trending lower, earnings growth trending lower, potentially market valuations trending lower, okay? The uncertainty surrounding all of these is what could lead to, or actually to me is what allows me to create a probability of volatility rising in 2022, probably at a higher level. It's growing. The probability of that happening is increasing and accelerating. Obviously, stay tuned, okay? Now, that doesn't mean that it's all going to be bad, because flip side of that, we have things as COVID is beginning to improve, even with Omicron, Omicrap, whatever it's called, okay? Data thus far says it's not as bad. Highly transmittable, yes, okay? That doesn't mean just go goofy out there and not use your head. because we're seeing a lot of people who are contracting the Omicron variant, okay, that are vaccinated. And people say, oh my gosh, vaccines don't work. No, you're looking at it wrong. How I interpret that is you have people letting their guard down who are vaccinated and going out and acting normal. If you've been around town, if you've been anywhere, okay, people are acting normal, okay? Very few masks indoors. Larimer County is still under a mask mandate. You know what? When I go to church on Sundays, I'm probably one of the few ones wearing a mask. That's fine. You do you be you, I'm being me, okay? It's still being smart. I think that's probably a lead. Anyway, as COVID continues to decline, which I anticipate it will as we move into 2022, that'll be a positive. You look at the labor market, huge gap in labor needs versus people out there that are employed. I think that is something that could continue to improve. So we'll see our labor market strengthen. Okay. Another thing, you look at supply glut. That's been a big one. You know, lots of stuff on boats. That's been the big deal, and that's been true. I look for supply chain to improve, which was going to do what? Improve economic activity. So there's kind of this balancing act, depending on how things come in, is really how the market is going to react and respond. Puts an increased emphasis on what we're doing and why, and keeping our eye on the ball, ignoring the narratives that are out there and focusing on the data, and let the data and the rate of change of that data drive what we're doing and why. Case in point, last month made a huge switch from being overweight commodities to none. Okay, commodities have rolled over totally, particularly in oil and ag. We've got some other areas on the materials side and whatnot that will come, I think. Oil is down 20% from its highs. Nat gas is down like 42% from its highs. Those are big inflationary drivers. So we're seeing things improve on the inflation side, which is going to, again, the ripple effect out there is going to see how does it impact the US dollar? How does it impact the bond market? Those things are not showing a massive fear component in what's happening. So again, we eliminated commodities. We've recently eliminated small caps because in an environment like we're heading towards, which is deflationary, small caps don't perform well. Commodities are terrible. That's what we're starting to see. So you have to focus on the particulars, which is what I talk about and emphasize and can't emphasize enough. Okay, moving on here. Let me flip my page here. FedPal had a big chat this week talking about the tapering, which the U.S. government's buying 120 billion of U.S. treasuries and mortgage-backed securities going back to March of last year, which is when the pandemic imploded. All right. Well, they've been decreasing their buying, in which they're going to accelerate that taper process to 30 billion per month. 20 billion of US treasuries means they're not buying that much. Okay, so you have to think about that. What's the imbalance going to be in the marketplace? Stay tuned. It's going to be a good one to watch. And 10 billion of agency mortgage-backed securities. So what they're going to be doing is the 120 that they have been doing is going to be at zero by March, mid-March of this coming year. It's going to be interesting to see how that impacts the bond market, because right now we have bond yields that are, again, trending downward sloping. We've seen the yield curve flat, meaning short end of the yield curve is impacted by what? Policy. That's Fed policy. We're going to raise rates. We're going to decrease rates. Middle of the curve to the end of the curve is really impacted by buying and selling and what's happening in the economy. Right now we're seeing yields trend downward in the middle of the yield curve to the end of the yield curve. We're going to continue to watch that because that could say a lot. Now, talking about rate raises and rate cuts, FedPal also threw out there that due to inflation, and now that it is not transitory, which I freaking told everybody that like 14 months ago, thank you very much. I will pat myself on the back on that one. He's talking about 3 rate hikes in 2022. I think he's blowing smoke. Lots of smoke. That was a smoke ring. It was such a fantastic amount of smoke. I think he's blowing smoke. I don't think he may get to 1. I don't think he gets to 2 or 3, because what he's going to see when we get into the middle part of the year of 2022 is we're going to see an economy, GDP, that's declining along with inflation. That is not the environment to be raising rates in. He may be handcuffed and have to If that happens, that will be very bad. You can sure as heck remember me saying that. It will be very bad. Okay? But let's go back to 2018 when Powell again was trying to raise rates and get back to a normal rate, and he was ignoring everything out there. He started this, and when we got into December, okay, the S&P peaked at 2939 in September of 2018. What does he start doing? Raising rates. Click, click, click. Okay. What happens then by December of 2018? S&P bottomed at 2346 or down 20%. Not good. If he starts raising rates middle of next year into an economy that's decelerating along with inflation, this could get real fun. Could get really, really fun. Stay tuned on that. Those are the things I'm watching. Okay, this is good stuff. In closing, I wish you all, first of all, happy Hanukkah. To my Jewish brothers and sisters, Merry Christmas. To those celebrating Christmas, if you don't celebrate either one of those, have a good end of December. Okay. Have a happy new year to everyone as well. I tell you, this has been a great year. I thank you all for tuning in. You made this a great year for Tanya and I, despite our COVID journey, which is improving. I will give you everyone the thumbs up. Things are getting better. My little gig that I'm doing with my new doctor buddy is working, albeit slowly, but it's working. So thank the dear Lord for that. But anyway, I wish you all a wonderful end of the year. Love up on your family, love up on your kids, love up on your friends, and be grateful, okay? Scientific studies show that people who are grateful are happier. That's scientific. That's not narrative, okay? So if you're struggling this year, because this could be a hard time of the year for people, I respect that. Find things you are grateful for and focus on those, okay? That's what you want to keep your eye on, that ball. Focus on the things that we are grateful. We all have much to be grateful for when you really take a step back and be honest with ourselves. So anyway, I love you guys. Thanks for joining me. It's been a fantastic 2021. I'm fired up for 2022. I mean that. I really am excited. It's going to be a great year. I know it is. Love you all. Take care. Wall Street X's and O's. This is Craig Model Mog. And for 2021, I am